Hey, I'm Daniel Snyder. This is Weekend Bite. In this week's episode, we're joined by our good friend and market legend, George Ball from Sanders Morris Harris. Now, before we dive into the conversation with George, I do want to briefly mention that the team over here at Seeking Alpha is currently running a Labor Day sale for anybody that's interested. That's 50% off your first year of premium membership. We're talking about all the data you want to get your hands on. You can find more details about that on the site, on the app, or under this video. Just check out the link. And now that the housekeeping is taken care of, let's bring George Ball into the conversation. George, it's always a pleasure to have you on the show. Thanks for joining us again.
I love to be referred to as a legend. A legend, as we all know, is a has-been, but it's better to be a has-been than a never was, so I appreciate it.
No way, man. We think you're a legend over here. We absolutely love you. I mean, we really love the insights that you bring. You've been in the market forever, right? And this is a time and a period right now where everybody, it seems, is looking at historical data and trying to figure out what do we correlate with what's happening right now, even though we've never been in this market before, right? So what are your thoughts about just what's going on in general? I know you have notes and thoughts on the inversion of the yield curve or what happened in Jackson Hole the other week, the upcoming Fed meeting. Give us what your take is.
Well, when you say that Seeking Alpha is having a Labor Day 50% off sale, same thing is broadly happening in the stock market today. I think the best thing the market has going for it right now is that almost every self-acclaimed or so-called expert, including me, thinks the market is going down. And if you have that much of a consensus on one side, usually it's wrong. But I will point out that Howard Marks, one of the smartest investors in the world, has articulated that the consensus is usually right. At the margins, it's not. And when things tip, the consensus is wrong. But right now, most people think that the market is headed down, and most people are probably correct in that view. We have a yield curve inversion that's strong. It's been around for a bit now, and it's probably the best single indicator of the direction of stock prices that we could find. Secondly, the Fed is not bluffing about being resolute. And therefore, you're not only going to see rates going higher, but you're going to see a runoff and maybe an accelerated runoff of the bloated $9 trillion Fed balance sheet. So if you're a betting person, and I understand investment is not betting, but you do want to get the odds in your favor, you probably are somewhat more bearishly minded than bullishly minded at this point in time.
George, let me ask you, because I mean, we're talking about a market being pulled back. So obviously people are fearful of what's to come, whether reduction of liquidity in the system, which it has to happen, right? Like they're doing $95 billion now a month compared to pumping $2 trillion right when COVID hit. I mean, they obviously cut to zero faster than they're raising their rates. And it's that steps up back to the level of normalcy, right? Or that's how we consider it, at least. But I got to ask you, what's your take? Do you think that there's a recession coming? Because I think that's what a lot of market participants are now thinking.
The recession question is a very telling one. It may not be that important for the marketplaces. Are we going to have a recession? If so, yes, probably mild. If not, growth, or at least real growth, is going to be skimpy for some period of time. The thing that everybody is looking at, I believe, is that good news as to the economy is bad news as to what the Fed is going to do in terms of tightening in rates. And therefore, if we do head into a recession, then the Fed may not have to do as much, and that's probably good for the market, even though it seems upside down. Will we have a recession? In a technical sense, probably yes, but very mild. I mean, one thing that we do forget is that in 2008, 2009, and in 2000, the degree of leverage in the economy was enormous. And right now, that's not true. The leverage was then 3.5 to 4 times debt to EBITDA. Now it's closer to 1 to 1. So companies are in a very, very strong place at this point in time. And I don't think you're going to see anything that's terrible in terms of a deep, biting, huge unemployment causing recession.
Yeah, that's what we all hope, right? Now, but as investors, we're wondering what we should be doing. I mean, we're hearing more references to Volcker, unfortunately, but is that just the scenario in? I mean, investors now, people have money in the market, they're watching their accounts, they're feeling the pain, right? We know the emotional feeling of pain is greater than when you see gains in your accounts and your retirement, your IRAs, or whatever it might be. So at this point in time, whether you're hedge fund manager, portfolio manager, a retail investor, what should people be thinking about doing right now?
Let me tell you a very quick Paul Volcker story. I worked at Prudential, and Paul Volcker was on the board there. I got to know him fairly well. And he said that he broke inflation, which he called a snake. He said, first I had to kill the snake, then I had to cut its head off to show it to everybody. And I don't think I was the only person that he used that metaphor with. The Fed today, I think, will be very aware of that. And they're not going to back off on killing inflation, because inflation, after all, hurts poor people more than it hurts wealthy people like you. And therefore, the Volcker analogy means there's going to be a continuance of a determination to make sure that inflation is dead. One way I'm approaching the market today is to look at an anomaly. Puts are usually viewed as something that one buys as protection against a declining market. And right now, investors, institutional and retail, are looking for protection against the bear market, and they're buying puts in quantity and size and at prices that are historically unmatched, so that the premium that people are paying to purchase puts, which are a lot of peas strung together, are extremely high, and therefore doing the opposite, I think, is a way for somebody to benefit if prices do go down further.
So when you say doing the opposite, are you referring to selling the puts to the people that are buying?
What I'm referring to is selling puts, and the premiums are extremely large right now on stocks that you want to own at prices where you're just plain going to buy them anyhow. We all have a list of a few favorites and say, well, gee, if XYZ were down, if Ford were down from around 15 to 13 or 11, I'd buy it no matter what. And so sell puts, and the premiums on an annualized basis on Ford and on other stocks are running 10 to 20%, great returns. So if Ford doesn't go down, I just pocket the premium, get a really good return on the capital that I set aside in case it goes down. And if Ford does go from 15 to 13 or 12, I buy it and I'm very happy.
Gotcha.
Now, there's nothing that's riskless, but I think that's a smart way to benefit from the very high level of premiums that a put seller is getting today. You've got to be sophisticated enough to understand it, but it can be a very nice way to accumulate a wonderful portfolio and get paid in the meantime.
Yeah, I got to tell you, I was actually just this morning before we're recording this, I pulled this up. Bank of America put out the similar strategy that you're kind of talking about. It seems like everybody is recommending now to turn to the option market, whether it's selling or buying. Obviously, if you're selling, you're collecting the premium, and you hope it works in your favor. Now, I know you brought, actually, before I go there, let me just mention as well, if you guys go to Seeking Alpha and find this article, maybe we'll link it below for you. But you can also come down here, how call options work. Put options are similar. We have a whole option knowledge base for you. You can dive in if you don't know how to handle that market. Jason, Jonathan, they've all put that together. Now, you brought us a few of your favorites. I wanted to ask you if you might be able to dive in and share these.
Well, I could use the line, these are a few of my favorite things. I think that comes from Sound of Music.
Yeah.
If people are old enough to remember it. Mercado Libre is the Amazon of South America. It's a marvelous company. The stock is way down now, and I'm saying if with the stock at 860 odd, you're willing to buy it at 670 and
820 a day.
and get paid nearly 10% for a 6-month put. So that would annualize to around 20%. Gee, that's something that as an investor, I would be happy to do. Again, there's nothing without risk. So if Mercado Libre goes straight up, I don't own it and I don't benefit from it. Or if it goes down below the 670 strike price that I'm talking about here, then I'm buying it eventually. It's being put to me at a price that's higher than the then price. So there's nothing without risk. But the odds with put premiums as high as they are very much in one's favor. Elanco, a veterinary company, stocks way down. It's the second largest in its business, and if it goes from 15 to 12 or so, gee, I would buy it without a thought. And again, in the meantime, I'm getting something over 13% on an annualized basis on a put premium. Ford is going to be probably the leader in the electric vehicle business, very strong underlying sales, and the parts shortage is beginning to wane. Delighted to buy it. So it's one of my favorites. And then if you want to be in, and I think you should, the private equity, distressed debt, finance business, BlackRock is a superb company. Anytime that you could buy it under 90, you want to. And again, the put premium in the meantime, even if you don't buy it, rewards you very, very handsomely. I mean, look at that. On an annualized basis, you might hope to get $17 on a stock that's under 100. So 17 or 18% return on your money, even if you don't buy the stock. Again, not without risk. You need to be sophisticated enough to understand what you're doing, but it could be a way to assemble a marvelous portfolio. And if you don't assemble the portfolio, you become quite wealthy simply with the distortedly high, historically, put premiums.
Yeah, so to summarize this, George, and correct me if I'm wrong, I mean, obviously you're talking about there is risk, and this is more of a sophisticated strategy that maybe not everybody that watches the show could get into, but is the overall idea right now to try to be focusing more on income plays, sort of similar to, you know, if I were to go into the marketplace, maybe find some strong quality REITs. You know, they provide 90% dividends to their shareholders every month. By the laws of that. Is that something that they might be able to look into as well?
REITs would be interesting, and I would especially emphasize at this point in time master limited partnerships. The returns are broadly over 7% in terms of income. Most of it is tax sheltered by the nature of the master limited partnership. And what people don't realize is that most MLPs have a cost of living clause in their contracts, so that if the cost of living goes up, they get higher prices. And so, at least indirectly, they're marvelous inflation hedges. So I think the MLPs, like the REITs, are very good for investors who don't want to take undue risk and they want to get paid quite well in the meantime.
And let's go ahead and leave it there, George. Your insights are always greatly appreciated. And just to clarify, we're talking about, like, you know, market's a little uncertain right now. Things about ways to produce income for your portfolio based on what you might have or other areas. Am I correct in that? Is that kind of what we're saying?
Produce income and reduce risk.
Reduce risk, definitely, indeed. George, really appreciate it. You have a great Labor Day weekend, okay?
Thank you. Enjoy the weekend.
All right, here we go. Let's get over to Seeking Alpha's Kim Kahn for next week's Catalyst Watch. Kim, before you dive in, did you know that this Saturday is National Cinema Day?
I did not.
Oh, man, do I have news for you and everybody else? Because, you know, we don't only bring news about the financial markets. I got to tell you, Regal Cinemas sent me an email. They're offering $3 tickets on Saturday for any format of movie. You could go see IMAX, you could do 4DX. I think people got to take advantage of it.
Oh, definitely for the IMAX. I mean, alone. Yeah.
For $3. Come on, what are the times? Maybe it's because of Cineworld's bankruptcy. Who knows? But
That could be it.
go ahead, take it away, Kim.
So we've got Labor Day on Monday, and it's quiet on the earnings front. It's quiet on the economic data front. So, I mean, if this was going to be a week where anyone wanted to take a step back from their portfolio and just stream a double feature of House of Dragon and Rings of Power, I wouldn't begrudge them that at all. But I do have something that is going on, and that is often neglected in the Wall Street calendar, and it's conference season. And these sector conferences really ramp up after the end of summer. And we're looking next week. I mean, just look at my list. We've got Citi Global Tech Conference, Barclays Consumer Staples, Goldman Retailing, B of A Media Communications and Entertainment, and Wells Fargo Healthcare, and plus plenty more. And what puts this into more perspective is that Wells Fargo actually noted conference season recently as a catalyst for their final trade of 2022. And they're recommending that short-term investors go in neutral into September, but watch the conferences. What you're looking for there is any pre-announcements. Pre-announcements are to the downside. Mostly they think that the bears take over and you want a short weakness going into the end of the year. But if you don't see as many pre-announcements, if they're pretty thin on the ground, they say it's going to be a sprint for the broader market going into the end of the year.
Do you think that there's any correlation or just happenstance that they're doing a global tech conference the week that Apple's holding their big September 7th event?
Yeah, I mean, I think that, they've got that, and there's also the Code Conference going on, which Tim Cook is going to be at as well next week, and as well as Alphabet and Amazon and California Governor Gavin Newsom speaking. So I think there's going to be a lot of action in the tech sector, and those are the ones they're going to have the biggest sway with their pre-announcements, definitely.
Yeah, it's something that I'm sure we're going to see a ton of headlines next week. We'll have to be all over it. Thank you so much, Kim. You have a great weekend. Happy Labor Day.
Thanks a lot.
All right, just a reminder for everyone that there is the Labor Day sale happening now. And you guys know what to do. Like, subscribe. If you're a fan of the show, give us a rating. Let us know what you like, what you don't like, depending on where you're watching and listening to this. So, I'm Daniel Snyder. This is Weekend Bite. Have a fantastic Labor Day weekend, everybody. If you're here in the States, and if you're one of our amazing international listeners, stay safe out there, and we'll see you next week.